And so as we go through this, if you have questions, you can raise your hands. There's a little chat bar there that you can raise your hand, and Melanie is on with us and she can monitor that and make sure that we've got everybody's questions answered. And so as we go through this, we will turn up my volume. Okay. All right, does that help? I hope that helps. Melanie just told me to turn up my volume, so hopefully that'll help a little bit. As we go through this, let's go ahead and jump in. So we're just basically looking at the markets today. We're not going to go through a whole lot of additional things. Usually we take a look at other areas, taxes and some of those type of things, but for today, we're just going to give an equity market update. Let's review this again. And as part of our services, and I apologize, all of a sudden my voice has gone away. Not good timing, but we'll make it work. The 5 areas of financial planning that we deal with, that we try to help all of our clients with: preservation, retirement, tax planning, estate planning, investment planning. And as we go forward with this, one of the things that we emphasize over and over and over again is that the investment planning side is only one of 5 of the areas that you need to be successful in your long-term financial planning. And as we focus, if we focus too heavily just on markets and what's going on with the day-to-day markets, a lot of times we miss the bigger picture of trying to accomplish longer-term goals. And so just a reminder that the markets are going to be volatile. They always have been, they always will be. Our goal is to create a plan that helps get us through these markets in a manner to where you can still accomplish your long-term goals, and focusing on all areas of the financial planning that are required in order to make sure that you're getting where you need to go. And so with that, let's just jump in. This first chart that we have just talks about economic growth and composition of the GDP. GDP stands for gross domestic product. It's basically the income statement of the United States. It takes into account all of the production, manufacturing, services, airlines, everything, and just takes how much income is being generated in the United States during the calendar year. And you can see here as we go through this, you can see that first quarter of 2022, we had a negative 1.6%. Fourth quarter of 2021, we had a positive almost 7% growth in the economy. And you will be able to see in some future charts on this that we are going to, there's a lot of things that are going into this, but for the most part, the economy, from our opinion, is in decent shape. It's not in perfect shape, obviously. The 2 biggest things that we're dealing with right now is inflation. That's the primary key that we have to deal with. And number 2 is interest rates. And everything else kind of ties into those 2 headwinds right now that we're dealing with. But what you can see here on this chart is that our trend growth clear back from 2001 has been about a 2% growth rate in the economy, in the GDP. And you can see that we're trailing off a little bit here. We anticipate that this may dip a little bit further, but we do anticipate long-term, over the next 3 years, 5 years, that this growth trend over the GDP will continue. We do not expect that to be all of a sudden to drop out from underneath and to not be able to have that 2% growth rate. So as we go through that, just keep that in mind, that the economy, our anticipation is that will keep growing. Yes, we have headwinds right now, but it's only a piece of the puzzle. Some of the things that are going on right now is that federal spending right now, last year, the federal deficit was at 12.4% of GDP. The deficit is basically the amount of money that we spent versus the amount of money that the government took in. And that will be dropping to where this year it's anticipated that will be less than 4%. Now, whenever we have a drop in the deficit spending, it acts as a drawing money out of the economy. It acts as a little bit of brakes on the economy, and there are other tools that we have or that the government has to kind of slow down inflation as well. But from an inflationary standpoint, and just to kind of keep this in mind, this is the biggest drop that we've had in GDP deficit spending as a percentage clear since World War II. So there is a lot of money that has left the economy basically just from the GDP deficit spending that has happened in the past. So number one, the tool that the government has to slow inflation is basically to take money out of the economy. They're doing that in two ways. Number one, they're tapering back on stimulus. And number two, they're raising interest rates. So both of those combined together should combat inflation in a manner that we should be able to get this under control. And I don't know if you saw yesterday, but just as a way of spotlighting, yesterday the Fed raised the interest rates 0.75%, and you saw that the markets were up like 3% yesterday. And the reason that the markets were up, even with the increase in interest rates, is because of inflation. And they're viewing that inflation will be short term. There are some things that will be a little bit sticky on it, but from an overall long-term standpoint, and we'll show this in other slides, and inflation is not anticipated to continue to at the same rate that we currently have it. All right, let's go to the next slide here. This is basically talking about US corporations and the labor force. And what you'll notice here in this labor force is that the unemployment rate, if you look at, this is COVID, when COVID hit and everybody, there was a lot of people that lost jobs. The unemployment rate jumped clear up to 14, almost 15% in April of 2020. You can see here that it's down below 4% right now, which is the lowest that it's been clear since the 1970s. So we have an exceedingly low unemployment rate right now. And you can see that wages are one of the offshoots of this, is that wages are growing, which is hopefully going to offset inflation a little bit and still allow consumers to continue to purchase. But you can see that that wage growth is growing above what it's been for some time. In fact, wage growth clear back here since 1981. So that is improving as far as people earning more than what they have earned previously. And that will allow more spending. It will allow more money to be flowing in the economy. So that's another balancing act that the federal government's going to have to kind of work through right now. Okay. Now, this is the inflation slide that we have. And what you'll notice here is in June last month, or at the end of June, and we don't have July numbers yet, but in June of last year, the inflation rate was at 9%. In May of 22, it was at 8.5%. 50-year average is right here on this blue line at 4%. You can see that we're well above trend. What is happening, and you can see this here in core CPI versus the headline CPI. Core CPI right now is 5.9, so roughly 6%. That is still elevated above average, but it is not as high as what the headline CPI. And what the difference between those two is that the core inflation takes out food and energy. And the reason that they do that is because both of those are highly volatile, cyclical type of measurements that they have. And so they try to take out those really highly volatile ones to give them maybe a little bit more realistic view of what's going on in the economy. And so it's just another way to look at the economy. But inflation right now is higher than it's been for a long time, clear back since 1982. This was during the Reagan era when they had to get a handle. You can see that inflation was up around 13% in 1980, 1979, in that area. We're not to that point yet, and obviously we don't want to get to that point. All right, let's keep going. All right, now one of the things that I want to kind of show here, this is the sources of earnings per share growth. So basically for every one stock that you own of a company, and this is the S&P 500, last year your earnings grew by 70% last year, year over year. This year we're up 6%. So we still have positive growth in the overall economy and in okay, I just got a question come in, so we'll answer that here in just a minute. You can see that this gray bar right here is from corporations going out and borrowing money. You can see that last year we had very, 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 very low interest rates. A lot of corporations went out and took advantage of that and used that money that they borrowed to build infrastructure, to build new facilities, to build new infrastructure as far as ability to make money. And you can see that earnings jumped dramatically last year above and beyond what they have been. Now, you can see here that because this gray bar is on the bottom, it actually is showing that some of that debt is now being paid back. And so the net borrowing is actually negative right now, but we're still at a 6% earnings with regards to what is happening in the overall economy. That's still a pretty good pace of growth long term. If we could have a 6% growth rate long term, and even with paying that debt back, that's a pretty good rate of return for earnings per share. Now, I had a questions come back that is the low unemployment because people have left, and the answer to that is yes. And we'll get to that in another slide. So hopefully we answer that in another slide. And if we don't, raise your hand again and we'll get through that. But what this is showing basically is that the economy is still in pretty good shape. Corporations are still positive as far as their earnings, and we anticipate that that will probably continue. So what this chart is global economic momentum. This takes manufacturing and services combined. And really all you need to know about this chart is green is good and red is bad. Anywhere there's green, it means that there's positive economic growth. Anywhere that there's red, it means that there's negative economic growth. And you can see here for the United States, we've been green here since in fact, heavily green since the second quarter of 2020 and have stayed in this green category for the whole time. You can see that back here, 2019, this is where COVID hit. You can see negative economic activity or economic growth. And so from an overall standpoint, the US is in pretty good shape. You can see here that Russia's in a little bit in the red. China's also a little bit in the red. We all know the reason that Russia is in the red is because of their war in Ukraine and what's going on over there. But China may not be quite as prevalent or obvious. And the reason that that is a little bit in the red is because they have adopted what they call a zero COVID policy, which means that anytime they have any type of COVID whatsoever, they completely shut down either the factory or the city or whatever it may be. And so that is right now hindering China's growth. Japan's a little bit red, but as far as the overall global economy is concerned, again, we're still in pretty good shape. Things are growing. Inflation's still a concern. We've got to deal with that, but as far as the overall global economy, we are still in pretty good shape. All right, let's go here. Let's talk about interest rates. Interest rates, we know that the Fed raised interest rates here yesterday. We anticipate that they're going to raise them again, and we will have those anyway. It's going to continue here for a little while, I think. But what you can see here is this is where the current interest rates are at right now. This blue line is showing what the Fed is saying that they're going to do. The green line is what the market anticipation is of what will actually happen. And you can see here that the market's anticipating that the interest rates will get up to about 3.3, and this will probably be by the end of this year. And then by the end of this year, they anticipate that inflation will more than likely be a little bit muted. And because of the aggressive policy that the government has been taking to get that under control, and that interest rates from that point forward could actually fall a little bit. At least that's what the market is projecting. Now, these always change as we update these numbers. I updated these numbers this morning just due to what happened with the Fed yesterday. And it's actually showing that the market is building in right now a little bit less aggressive stance than what they were even yesterday. And the market really liked what the Fed did yesterday. You can see here in GDP real growth quarter to quarter, you can see that in 2022, they're still expecting roughly 1.7% growth in GDP. Again, that's net growth going forward, meaning that the economy, the income statement of the United States is still projected to be growing. You can see that it stays there in 2023, and in 2024 actually inches up a little bit. And in the long run, we'll settle it in about 1.8. Now, here's kind of the inflection point that I want to address. Over the last 5 years, we've had a really, really good market. With everything that's gone on with the stimulus, we had a massive stimulus hit the economy, very low interest rates hit the economy, and that basically made it so that everything grew, and we grew at a substantial rate. You saw that in the prior slide of earnings growing at 70% last year. And they anticipate going forward that now that we have to pay some of that debt back, we're not going to have as much stimulus going forward. It's going to be more of a normalized economy going forward. And we've got all of these cross currents happening in the economy right now that are kind of, one goes one way, the other goes the other way. And the market right now, the reason that it's been so volatile is because it's trying to figure out what those cross currents mean in the long term. But the reality is that the markets are still anticipated to grow, but probably at a muted rate of return. So over the last 5 years, we've had returns in the overall stock market and the S&P 500 of probably around 12 to 13%. We're anticipating over the next 5 years to still have returns in the marketplace of somewhere between 7 to 8 to maybe 9%. But again, good returns, but just not as good as they have been over the previous 5 years because of all the stimulus that has happened. All right, let's keep going forward. All right, interest rates and inflation. Basically, what this is showing here is that inflation right now, what this is showing is taking the interest rates of the 10-year Treasury, subtracting out inflation, and giving us what's called a real rate of return on Treasuries. And what's showing here is that the real 10-year Treasury yield right now is negative, which means that anything that you've got in the bank, anything that you've got in CDs, anything that you've got in any type of money market or guaranteed type of an account probably is not going to get a return that's above inflation. And this is significant because in our long-term goals and in the long-term things that we're trying to help our clients accomplish, you have to have a return above inflation long-term. If you don't have a return above inflation long-term, you're actually losing purchasing power every single year. And the reality is that if you're losing purchasing power every single year, from a sheer economic standpoint, it would be better for you to spend all of that money right now while you can purchase more than wait for 10 years to where your purchasing power is substantially less and not being able to purchase as many goods and services tomorrow as you would be able to do today. And so from a goal standpoint, this is something that we've really got to be careful of going forward in our long-term projections, in our long-term as we're trying to help our clients accomplish their long-term goals, this is probably as important as anything else that we can communicate to you, is that we've got to have an investment portfolio that long-term will outpace inflation. It's just critical to accomplishing your goals. Now, interestingly is that what this chart, and I'm just going to focus over here for just a minute. What this is showing is that if interest rates go up or down by 1%, what happens to the bond market? And the one that we want to focus here is the US aggregate. Is kind of the overall, it's the equivalent of the S&P 500 for the equity market, but this is for the bond market. And you can see here that the pricing right now, there is a concept in bonds, and that's called carry. And what happens is that when interest rates or markets or credit or other influences come to play in the bond market, a lot of times what happens is that sellers will sell more at a discount than what the current economic situation actually warrants. And you can see that here. You can see that bonds have been substantially oversold, in that if interest rates go up, they're expecting a downturn of about 2.9% in the overall bond market. But if interest rates come down, they're expecting a 10% increase in the bond market. And so as inflation gets under control, based upon what we've looked at in the past, there have yet to be a 3-year period where bonds have been negative, meaning that we anticipate that within the 3-year period that bonds will be positive and still get a little bit of return for you. The bonds right now are very challenged because of the rising interest rate environments. That's one of the reasons that we've told all of our clients going forward that any money that you're going to spend within the next 3 years, we don't want to touch, because we want to make sure that this can go through a complete cycle, make sure that you're still getting, having the liquidity that you need for your income needs, and just making sure that this is working for you. So anyway, just an interesting slide there from that standpoint. Now, S&P valuations here, you can see that what this is doing is this is a multiple on earnings per share. And basically all that happens is that you take the amount of earnings that a corporation has, you divide it by the number of shares outstanding, and it gives you the multiple that you're paying for the stock. For example, if a corporation is earning $10,000 in income, and your multiple is 10 times, then you would be paying $100,000 for that earnings going forward. You can see that this 25-year average is at 16.87. You can see that right now we're at 16.9. As of last week, this was actually below the line just a little bit. So we're right at the long-term average as far as the overall earnings per share. What that means is that the market is not overpriced, nor is it underpriced right now. There are, however, segments of the marketplace that are underpriced, and there are segments of the market that are overpriced. And having a diversified portfolio and just being able to manage that is probably going to be pretty critical. All right, one of the things that I want to show you here is this is kind of our, I don't know, we call it our Amish quilt. But what you'll see here year to date, the only asset class that has been positive is commodities. And most of that has been driven by food prices. Most of that has been driven by energy prices. And without those two, this commodity would have been negative. And but you can see cash just barely breaking even, fixed income negative, large cap down, high yield down, real estate down, small cap down, domestic equity down, emerging markets down. The thing that I want to show you here is that there has been no place to hide. It doesn't matter what you have invested in unless you are in cash. And if you have a diversified portfolio, your portfolios are down. And it's just what the market has given us at this point, again, because of the cross currents and what's happening. But we are watching this on a very close basis with the portfolios and making sure that everything's working. Now, I want to, There's another slide that I don't have on here that I want to address, and it'll come back to the, in fact, let me go back here. Yeah, there's another slide that I don't have on here, but we've got a question that has come up with regards to unemployment. And the question was, is the low unemployment rate because people have left the market? And the answer to that is yes. And the answer to that is also maybe, and the answer to that is also no. So I'm very committed to that answer. But the reality is that right now, the statistics are is that for every person that is seeking a job right now in the economy, there are 2 openings, meaning for every corporate opening that there is, there are 2 of them for every 1 person seeking a job. What that means is that corporations right now want to grow. They have capacity. They can see that their balance sheets, that they can improve them if they can get more help. And this really deals with a lot of different aspects. One of the aspects that has hurt, in fact, I'll kind of go back. One of the ways that the US economy has managed labor force is not only from the domestic labor force that has come from US citizens, but it's also come from immigrants. And because the immigration has been shut down so heavy, we are lacking people for jobs right now. And this is, again, this isn't a political statement. It's just the reality that we don't have enough people filling jobs right now. But if you were a corporation and you were wanting to grow, you'd need more employees, because right now it's really hard to find. So again, corporations are in good shape. They have a lot more cash than they had in 2008 when we had the big correction. We're not going to go through another big correction. The other thing that I want to just address is a recession. There's a lot of people right now that are saying, oh, what happens if we go into a recession? And the reality is that even if we do go into recession, it's going to be a mild one, just because of where corporations are sitting right now. And in addition, the measurements for recessions have changed over the last year, and the government's trying to redefine them a little bit. But the reality is that based upon the old way of defining what a recession is, the reality is that we may already be in a recession. And we won't know it because it's a backward-looking criteria that they look at, and you look backwards and we may already be out of a recession before we even know that we were in one. And we anticipate that even if we have a recession, based upon the numbers that we're seeing and the economists that we follow, they're giving it about a 50-50 chance, 50% chance that we won't be in a recession, or 50% chance that we will be in. And it really depends upon what happens with the government. It happens with regards to interest rates and inflation going forward. So long term, here's what we're trying to communicate to all of our clients. Number one, this is not the end of the world. This is not the final act of our economy. And the economy is still in actually quite good shape. It's been in better shape, but it's not the worst that it's been either. So we're kind of right in the middle as far as the overall economy. The COVID is still hitting the economy a little bit, not as much as it was in the past. There's still a few supply chain issues that once those are worked out, we'll probably see a bump in prices. As inflation tapers down and we see a little bit of taper in inflation, you're going to see a bump. But one of the things that I want to communicate, and I want to make sure that everybody kind of understands this, is that the market right now is looking for, it understands kind of where the economy is, and it's just waiting for something to appear from a news or from earnings or from inflation or from interest rates. And once that happens, you're going to see a pop more than likely. Again, we don't guarantee and we don't have a crystal ball, but more than likely, you're going to see the market pop really quickly. And you're going to see, our anticipation is that once those things start happening, that you're going to see a fairly quick recovery of the marketplace. And if you're not invested, if you are out of the market, or you just are nervous and you're just kind of wringing your hands, our encouragement is that we've got to find a way for you to participate in the market and make sure that you're recovering those gains that you've lost. Because if you stay out and most of those gains happen over a month or a month and a half period of time, and then all of a sudden you feel more comfortable in getting back into the marketplace, most of those gains will already have been made, and you won't have the recovery in your portfolio as quickly as you otherwise would have had. So let's conclude our workshop for today with one more slide, and then I've got a few follow-up things. But consumer confidence right now is a measurement that's taken on a monthly basis. And what you can see here is on the lows on consumer confidence. This is 75, 1980, 1990, 2003, 2005, 2008. What this shows is that based upon consumer confidence, what the next 12-month S&P returns are. And in 1975, from the low part of the consumer confidence, in the next 12 months, and this goes back to our previous comment, the market was up 22.2%. In 1980, it was up 20%. In 1990, it was up 29%. 2003, it was up 32%. 2005, up 14. 2008, up 22. 2011, up 15. 2020, up 43. And the thing that I want to show you here is that the consumer confidence was down below this line. It was at 50 even last week. So it's come up just a little bit off from last week. But you can see that the consumer confidence here is as low as it's been ever since they started measuring this index. And what this means to us is that as soon as this consumer confidence starts returning, even in a small degree, you're going to see a fairly quick and a fairly rapid upturn in the marketplace, more than likely. Again, no crystal balls, no guarantees, but that's our anticipation as far as what's going to happen going forward. And you can see here that 8 peaks, 8 troughs, the subsequent return is an average of 24%. And if we get that 24%, that probably will make up all of the losses that we've had so far this year in the marketplace. So again, patience, long-term goals, making sure that we're addressing your liquidity needs, making sure that you've got enough money that you can manage your day-to-day. But again, this is a good market to be investing in. We're in a good spot. The economy's in a decent spot, and it will continue to improve over the next year to 2 years. And so patience, and just let us hold your hand and let us get you through this. The bottom line is that we are proceeding with caution as we're going through this. We're a little bit more liquid than we have been in the past, but trying to make sure that everybody's got cash flow and making sure that everybody's goals are being taken care of. As we go through the outlook, I'm going to skip through these for just a minute. Takeaways. We're still going to have volatility as we climb the wall of gains on the other side of the downside of this marketplace. We're still going to have volatility, and it's going to take a little bit of patience to get through that, making sure that you're focusing on your goals, your long-term goals, and just not the current market of what's happening and what's going on today. And we are always available. If you want to call and just go through your portfolios, if you want an additional review this year, we are more than happy to help in any way that we can. We're grateful that we have this ability to reach out to everybody via these webinars and kind of hold hands and give a little bit of additional information. But thank you for your participation. So our goals and what we're doing here is that we, again, are looking at the portfolios on a regular basis. We're also trying to communicate more than usual during this downturn. And then also looking at the tax consequences of what's happening. One of the things that we've been doing right now is that for those that Roth conversions make sense. We've been doing a lot of Roth conversions while the markets are down, so that those amounts, as they come back, will all be in a tax-free account so that you won't have to pay taxes on those going forward. So again, some planning strategies that we've implemented during the downturn to try and take advantage of it and not just have it take advantage of us. As always, we very much appreciate your sharing our services with your friends and family and other co-workers and other people. We send out our monthly newsletters. If you would like any of your friends to receive those, just give us a call and we can get those on our list. And then also we've got our advocate event in St. George this year. It's going to be on Thursday, September 15th, 8 o'clock. Joseph, the amazing Technicolor Dreamcoat. Qualifications for this are just referral for someone that comes in that meets our minimums and that does an initial consultation with us, and that qualifies you to come. It's completely paid for by OakBridge. We're giving a night stay at a hotel for you so that you can be there Thursday night, as well as the play at the Tuacahn. We did it last year and it was just absolutely wonderful. So we hope everybody can qualify for this and come with us to St. George in September. With that, we'll go ahead and wind down. Thank you so much for calling. If anybody has any questions, I'm happy to stay on for just a minute and answer questions. But with that, we're probably good to go. Thank you so much for coming. We appreciate it very much.